So a questioner asked me, Rick, what would make you sell your gold? And I think that's a really interesting question. I can tell you what to buy it. Here's what I would sell it. When we balanced our budget. When we had a fiscal scheme that was popular among our elected representatives that dealt with the net present value of $100 trillion in unfunded liabilities. And when the interest rate on the U.S. 10-year Treasury exceeded in real terms the depreciation in the U.S. dollar. If, Danny, your listeners believe that the CPI is the real rate of depreciation of the U.S. dollar, they can feel sanguine about it. When I look at the basket of goods and services I buy, it would appear to me that rather than the 2.6% stated rate in the CPI, that the purchasing power of the goods and services I buy, gasoline, groceries, health insurance, stuff like that, is increasing by about 7.5% a year.
You're watching Capital Cosm. My name is Danny. It is May 5th, 2025, and today's guest is none other than Rick Rule. Rick, thank you so much for coming back on the show, my friend.
Pleasure to be with you, sir. Thank you for having me back.
Yeah, definitely. Fan favorite, Rick Rule. We're always thrilled to have you on here, Rick, to get your insights on all the things going on. And, it seems like we talk for about every month or so, and it seems like the last time we spoke was it feels like a year ago, given all the events that have transpired since then. So I'm going to put the ball in your court here, Rick. Given everything that's going on, what do you think should be on the mind of investors right now? Where should they be focusing their attention to at this moment in time?
Well, I think a few things, but I think that the volatility that we're going to expect over the next 2 years is greater than the volatility that we've come to expect over the last 40. Investors need to be prepared for that financially, which is to say they need to maintain higher cash balances than they otherwise would. Those cash balances are important for two reasons. They give you the tool to take advantage of volatility as opposed to being taken advantage of by it. But they also give you the courage. Having the cash often gives you the ability to use it. And we will have situations, I think, over the next 2 years where there are some fairly short-term but fairly severe market panics. It's important that you also have the psychological stability to weather the panic, that you use it as an opportunity to take advantage of other people's mistakes rather than making your own. I think a second thing that people probably need to pay attention to is that market leadership and rotation is going to change a lot. And I think particularly for people with a trading orientation, I don't have a trading orientation, but for people with a trading orientation, you're going to have to change from what's hot to what's not quicker than you used to have to do it. Too many people, in my estimation, over the last 40 years, have required the price action of an asset class to justify the narrative around the asset class. I remember back when uranium became hot. When the uranium price had to go up at $20 a pound, nobody but it wanted to own it. Mm-hmm. When the uranium price went up to $80, it didn't have to go up anymore. The price action had justified the narrative, so everybody stormed into it on top. And I think that most people need to change their orientation, not look at what's hot, but rather what's not, what will become hot. I think that's very important. So liquidity and a propensity not to chase fad, but rather to chase logic, I think is going to have to happen. In my own sector, we're in a really good gold trade right now. And somebody needs to decide what kind of investor they are. If they're traders and they became involved in gold 2 years ago and gold is up, 35%, maybe you take some money off the top. Maybe you take some money on it. If you bought it because it wasn't in vogue, it's coming in vogue. And if your reason to own gold was because you thought that gold would go through 3,000, now that gold's gone through 3,000, maybe you want to sell some. For me personally, I think gold has much farther to go. I'm an investor. But if gold pulled back 15%, it wouldn't change my thesis whatsoever. So for me, I'm going to own some gold. Continue to own gold. If you continue to own gold, I think you have to own the gold stocks because the gold stocks relative to the gold price are very, very, very cheap. If the gold price holds up, operator margins uh, will increase very rapidly, which is to say the money that they sell their gold will greatly outpace what it costs them to produce. And if that takes place, the equity markets will certainly take note of increasing cash flow and earnings. Investors in other sectors, in the resource sector, need to pay attention to changing supply and demand equations. As an example, oil in the 50s won't last. The truth is that the total cost to produce oil on a global basis, not just the lifting cost, but rather the social rents and the cost of capital, are over $60 a barrel. When you see oil in the 50s and you see the oil stocks sell off, if you're patient, buying oil at that period of time and then revisiting the trade when the oil quote is 75 or 80 is a wonderful trading strategy. It's a truly wonderful trading strategy. Of course, it takes courage. And I guess if I had any single piece of advice to offer people, courage is what's going to be required over the next 5 years.
Yes. So essentially, have some liquidity, have a decent sized cash position. What that cash position is depends on the type of person, each individual's particular circumstance. And then at the same time, also be ready to pivot be what do they call it? Be agile, or I believe the term was nimble. Nimble, that's the term. So be nimble and have liquidity, have some dry powder. This is a question I often grapple with is people have different circumstances. There's young, there's old, there's rich, there poor. How does one determine, if are there any rules of thumb to determine one's allocation size, liquidity allocation size? Are there any that can help people out? Not like, I'm not just asking for a number, but is there like anything people should consider about? Because Warren Buffett I believe he has a cash and cash equivalent position of near 30% now, which is for him an all-time high. He just retired last weekend from Berkshire Hathaway as their CEO. Is that a tell for something? I don't know. I don't know Warren Buffett, but very interesting nonetheless. But how do investors in your mind, what are some good practices to consider when trying to figure out how much liquidity one should have, how much dry powder one should have?
I think anything less than 10% is silly.
Mm.
For me, some of that liquidity is in gold because I'm not afraid to sell the gold to use it when something gets cheaper. Other people who don't want to sell their gold probably need to consider it as an investment as opposed to liquidity. I think the second determinant in terms of portfolio allocation, how speculative one can be, really is simply a function of how hard you want to work. If you aren't willing to work, if you aren't willing to spend at least 1 hour per month on each of your holdings, then you can't afford to be very speculative. If you are willing to work hard enough to give yourself a definable competitive advantage over other investors and speculators in the market, if you are willing to work hard enough that you can have some sense of what something is worth as opposed to what it's selling for, those are very different numbers, then you can afford to be more speculative if you want to. I would encourage both investors and speculators to think in much longer terms than they do. Danny, I've graded tens of thousands of portfolios in my life, and we'll talk about that later. And grading those portfolios has allowed me to look at investors and see the mistakes that they commonly make. And I would suggest that one of the most common mistakes is that while people are often very right about their investing themes, the themes that they're investing in might take 3, 4, or 5 years to play out. And those same investors seem to have trauma holding stock over a long weekend. If there's a big mismatch between your strategy and your tactics, likely you're going to lose money. And when people make an investment, they have to ask themselves why they're making an investment. As an example, maybe somebody believes in resources that the political challenges around supply chains means that Chinese dominated supplies like antimony, rare earths, things like that will become more valuable in the West. It will take 3, 4, or 5 years for that to play out. If you're buying a rare earths company or an antimony company or a lithium company based on a 5 year time frame, and you allow yourself to get shaken out of the stock in July, you understand there's a mismatch
Yeah.
between the time required for your investment thesis to play out and the time that you've allowed it to play out.
I see it all the time in my comment section. I'll do interviews like this where there might be like a 1 day lag between the recording time and the release time, and we'll release the interview, and then I'll get comments like if it's like an interview that's bullish on gold or XYZ asset, if at the time of the release that asset has gone down for the day, I'll get comments like, "Oh, well, gold went down today. So what do you mean? Why are you bullish?" I'm like, okay, listen, like, just because it's down for 1 day doesn't mean you just pack up shop and go home. What goes up in a straight line, anyways?
You
Like,
know,
what do
Danny, in
you?
fact, if you believe in the thesis and the price went down, that means it's cheaper.
Yeah,
You need to ask those subscribers if they went shopping for a winter coat, would they rather pay $500 for that coat or $400? It's
very true.
odd that people buy financial assets differently than they buy physical assets. I think if people bought financial assets the way they buy physical assets, which is to say they bought them on sale, that they'd have better outcomes.
Yeah. Yeah. Well, let's get your thoughts on. I did mention gold. I want to get your thoughts on gold. And it seems like you're kind of in the camp that yes, it did have a legendary run. My words, not yours. But if you agree, I mean, if you agree with it, let me know. But a pretty strong run for the last year and a half. There is some there is some sentiment out there that it may have overstretched itself in the process of doing so, but you appear to be in the camp that there is still some decent upside to go. Now, is that from a short-term view, a mid-term view, a long-term view? How far are you looking out there?
I think in the near term, there could
Mm.
easily be a pullback. Uh, and by the way, I would say, when you and I first started having our interviews a couple of years ago, people would say to me, "Well, Rick, when's the gold price going to move?" And I would say to them, "Well, I think it's going to move in the year
Yeah.
2000. In the year
Hmm.
2000, it was $250 an ounce. Now it's $3,000 an ounce. It's up 12-fold. What do you want? Gold has done its job.
And you still hear people saying that today.
Absolutely. And I'll answer the question differently. On my own podcast at Real Classroom, a couple weeks ago, I said to the audience, here's why I own gold. I own gold because the world's reserve currency, the US dollar, has some challenges, not relative to other currencies, perhaps, but absolute. Those challenges include off balance sheet liabilities, according to the Congressional Budget Office, which exceed $100 trillion, and on balance sheet liabilities that exceed $36 trillion, and a complete unwillingness with voters and hence politicians to trim spending. We had this situation once before in my life in the 1970s. And during the 1970s, the US dollar lost 75% of its purchasing power, according to the Office of Management Budget. And not coincidentally, the gold price went up 30-fold. Now, while I don't think the gold price goes up 30-fold from here, I do believe personally over the next 10 years that the US dollar in absolute terms loses 75% of its purchasing power. Traditionally, what's happened is, particularly during periods of artificially low interest rates, when the dollar loses purchasing power, that gold goes up. So a questioner asked me, Rick, what would make you sell your gold? And I think that's a really interesting question. I can tell you why to buy it. Here's what I would sell it. When we balanced our budget,
Mm.
when we had a fiscal scheme that was popular among our elected representatives that dealt with the net present value of $100 trillion in unfunded liabilities. And when the interest rate on the US 10-year Treasury exceeded in real terms the depreciation in the US dollar. If, Danny, your listeners believe that the CPI is the real rate of depreciation of the US dollar, they can feel sanguine about it. When I look at the basket of goods and services I buy, it would appear to me that rather than the 2.6% stated rate in the CPI, that the purchasing power of the goods and services I buy, gasoline, groceries, health insurance, stuff like that, is increasing by about 7.5% a year.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
So the idea that I would save at 4.2 in a currency that's costing me 7.5 seems like very bad math. So what would cause me to sell my gold? A balanced budget. Positive real interest rate after the deterioration of the purchasing power of my savings, and a fiscal plan that deals with Medicare, Medicaid, Social Security, a fiscal plan that deals with $100 trillion in net present value of unfunded obligations. I'm not making a market forecast, but it's very, very, very easy for me to see 5 years out, 6 years out, 7 years out, $10,000 or $12,000 gold in nominal rather than real pricing, which is to say, if you devalue the dollar, if you reduce the purchasing power of the US dollar fourfold, or pardon me, by 75%, I could see you increasing the nominal value of gold fourfold.
And I think that's a very insightful thought experiment to not just employ on gold, but any asset that you hold. Just ask yourself, what would it take for you to sell XYZ asset? I think that'd be a very good thought experiment to do on oneself every now and then. Given what we've seen, especially after Liberation Day, I kind of view that as kind of like a trial balloon in terms of if we do ever get like this big market crash and correction, what each asset class does, we kind of saw some light being shed on those 4 or 5 days that we saw that sell-off occur. Number one, the stock market fell. Number two, what also fell was bonds. Yields did have a momentary lapse below 4%, the 10-year that is, but then skyrocketed back up, even touching 4.5%, indicating weakening on the bond market side. Now, this is very interesting, and conventional wisdom would have you think that when you're seeing weakness in the stock market, you should see some rotation into the bond market, but this is obviously not the case back then. Gold also retreated back, but from a relative standpoint, it performed better than the stock market and the bond market. It even performed so well that it even made an all-time high at $3,500. So is it different why are we seeing so many rules being broken? Why did we see so many rules being broken back then? Is this a kind of a harbinger of things to come? Is there a tell in any of this?
Well, I think, again, it has to do with one's orientation. We'll return to interest rates. But in a real sell-off, in a panic, no asset class holds up. Partially because people react instinctively as opposed to intelligently.
Oh, and also, just one more thing. Just one more. Sorry, I didn't mean to interrupt. The DXY also went down too. So that was very interesting.
That surprised me. Yeah. That did
Go
surprise.
Ahead.
But often the sell decisions are made by margin clerks. They're not made by investors, which is to say heavily leveraged investors, where they violate the terms of their margin agreement, The margin clerk will sell what has a bid, not what the investor values most highly. All bets are off in a panic, which is why you have to have cash to take advantage of other people's stupidity. The second thing that you mentioned, though, is very interesting to me, which is the interplay in bonds. Uh, for the last 40 or 45 years, when people have been concerned, the flight to quality has been to the US 10-year Treasury. You will notice that at the same time that the administration, the Fed, and in particular the president, is trying to talk down interest rates and literally trying to force down near-term rates with liquidity, that the long-term rate is rising. That would suggest that the Fed is beginning to lose control of the interest rate, and that investors share my view as to the real deterioration in the purchasing power of the dollar. If you believe that the deterioration of the dollar is at 2.6%, and the US 10-year is paying you 4.5, you're doing okay. 1.4% riskless, that's okay. If you believe, like I believe, that the real deterioration of the purchasing power of your currency is 7.5%, then 4.5% is not okay. If you invest money in the US 10-year Treasury for 10 years, and they cost you 3% a year in purchasing power compounded over 10 years, that's a really, truly lousy outcome in a so-called riskless asset. And so I think the odd performance of the bond during the last panic might have been particularly telling.
Yeah. Yeah. And we do appear to be in a very pivotal time, especially for gold investors and people who may be considering adding more to their stack or subtracting some from their stack. And this is why I think your gold boot camp part two coming up can help illuminate, can help shine a light and make those decisions a little easier. Go ahead and talk about what we can expect from part two of your gold boot camp. And do you also need to have watched part one? Did you have to be a part of part one in order to be able to understand what we'll go through in part two?
Part one was useful and helpful. What we tried to do in part one is talk about the factors that move the gold price. Turned out to have been an extremely topical boot camp. Suffice it to say that we have a bias in part two that the gold price will hold steady or increase. If you don't share that bias, you might not want to be part of the boot camp. The second boot camp will have less to do with buying physical gold and the reasons to own gold, and more to do with very high quality gold companies. If you look back at prior precious metals bull markets, those bull markets are always led by the commodity itself. But eventually, when the narrative associated with increasing metals prices reaches the broader public, market leadership switches from gold to the gold equities. And traditionally, in gold equities bull markets, merely market beta, defining beta as the extent to which the gold stocks outperform the broad stock market, you can expect a 200 to 300% return. We have had thus far, as measured by the XAU, about a 50% return. This will tell you how to take part, the second part of the bull market. We have gold mining stocks that on a price to net present value basis or a price to cash flow basis are selling at the lowest multiples that we've seen since 1975. If you believe that the gold price will continue at current levels or go higher, what you will see is a fairly dramatic catch-up, not just of the penny dreadfuls, not just of the highly speculative explorers or developers, but rather the best of the best. The Franco-Nevadas, the Wheaton Precious, the Agnico Eagles. And what we hope to do in this is teach people how to invest in the best of the best. One thing you could do is simply buy an ETF. And for some people who don't want to do any work at all, that's not a bad strategy. What we try to teach you to do at the boot camp is to look at the 40 companies that might comprise an ETF and ignore the 20 poorest companies.
Mm.
What we really try to do is teach you how to look at that basket of 40 companies and select the best five or six. Ironically, that five or six, because they are such high margin producers, might underperform the 40 a little bit in a raging bull market, but they do so with substantially less risk. They're much higher quality companies. What we're going to try to teach you how to do is, if you believe that the gold price stays at its current level or goes higher, there are in the universe of 40 to 60 potential ways to play that game, five or six or seven clearly superior ways to play the game. And we hope to teach you that. And by the way, name names.
Wow. Really looking forward to this one, Rick. We have a special link down below for you guys if you are interested in checking it out. Rick, let's talk to the silver stackers here as well. Silver, although it has risen up from the doldrums of the $20 handle, it's still nowhere near an all-time high, much like its brother or its big brother gold has. Let's speak to the silver stackers out there. Is silver still? Do you still anticipate silver lagging behind gold here moving forward as well, or no?
You know, Danny, in 50 years of following these markets now, and I can't tell you why this is, I'll just tell you that the anatomy of a precious metals bull market is like this. Gold, the metal moves first.
Mm-hmm.
Then the gold stocks move. After the momentum has been established by the fear buyer in gold and the gold stocks, when the generalist money is attracted to the narrative and they come down into the sector, perhaps because of silver's lower unit price, or perhaps because of its reputation for volatility, or perhaps for both, silver begins to outperform gold. And by the way, when that happens, you won't need Rick Rule to tell you it's happening.
Mm.
It is very, very, very dramatic. Now, I believe that silver is a speculative as opposed to an investment asset class. But for part of my life, part of my financial life, I'm a speculator. And the returns that I have seen in high quality silver stocks are so dramatic that I personally can afford the wait. I have no psychological trauma waiting because the returns I've enjoyed have been so great. Let's look back to the decade of the 1970s. Sadly, I was too young, too dumb, and too poor to take advantage of the beginning of that part of the market. But in that market, one stock, Coeur d'Alene Mines, ran from a low of 10 cents in 1970 to a high of $61 in 1980, a tenfold return over the decade. Fast forward to the great little silver market we had in the early part of the 90s. Two that I did participate in, Pan American, which went from 50 cents with, by the way, a full warrant, to a high of, I believe it was $45 in 7 years, and Pan American Silver, not Pan American, pardon me, Silver Standard,
Mm-hmm.
which went from 72 cents to also a high of $45 over 6 or 7 years. The point of this is that the most dramatic performance, albeit speculative performance, not investment performance, but speculative performance that I see in precious metals markets is that sort of limited ghetto of high quality silver stocks. You point out that with regards to the metal, gold has at least reached nominal all-time highs, which is to say, silver at $33, $34 is lower than its nominal $50 high. It's much lower than its real high. If you inflation adjust today's $33 relative to the old $50, you'd probably need to take out 80 or 85 to see all-time highs. And if I am right, that we are in a genuine precious metals bull market as a consequence of the deteriorating purchasing power of the US dollar, you will see generalist investors coming down into the space. You're starting to see them now.
And
at some point,
go ahead.
pardon me?
No, I was just going to ask you a follow-up question, but go ahead, finish your thoughts.
At some point in time, if past is prologue, I've seen it happen 3 times before in my life, silver will begin to outpace and outpace dramatically gold. Uh, Investors or speculators who want to see that may have to wait a year, or they may have to wait 2 years. From my own background, the rent you get paid when it occurs accommodates almost any weight that you want to hang on it.
And you also have this 100 to 1 silver to gold ratio as well. I mean, that's fairly anomalous. I was looking at the chart the other day, and that's only happened once in history, twice if you include COVID. But COVID was outside of the normal series of events in history. So if you want to count COVID, it's happened twice before. If not, it's happened once. Do we go further up in this silver to gold ratio from here, or what?
I'm not sure because silver to gold only talks about the ratio, which people should say should be 16 to 1,
Hmm.
reflecting the material's relative scarcity in the Earth's crust, doesn't deal with utility.
Yeah.
So I'm not sure that the ratio really should matter. Psychologically, however, the ratio matters a lot. And in the near term, markets are often psychologically driven. I could see a circumstance, I'm not saying this is going to occur. I could see a circumstance where gold went through 50, and the gold pundits would say that doesn't matter. The gold to silver ratio is only 70 to 1. It should be 16 to 1. That would be a justification for the silver price to go higher. It might not be a real justification, but speculative markets don't need real justification. By the way, when the popular price began to say that although the silver price has doubled, it should go up for here because of the ratio, I would probably use that personally as an excuse to sell some silver.
Mm, that's a good point. Before we wrap up here, Rick, I want to get your thoughts on the Canadian election, the more particular, the election of Mark Carney. We talked about this in a previous podcast, and I believe your words were a truly horrifying future awaits Canada, or something along those lines. Should someone like Mark Carney get into power, because he's kind of like a competent bureaucrat. He's a competent technocrat. What's your overall view on his election? How do you view Canada moving forward from here?
I think it's depressing in many lights. I think it's depressing that the Canadian electorate chose a socialist statist as prime minister. I think it's unfortunate that the Canadian electorate believed Mr. Carney when he did 2 things. First of all, he was campaigning against Trump, who was not their prime minister. And secondly, Mr. Carney ironically campaigned on a platform of change when his party had been in government for 10 years. The fact that the Canadian electorate was inclined to do that is, I think, unfortunate. I think the American electorate has made some unfortunate choices too, but that's a different question. What really scares me is I see Mr. Carney as somebody who embodies the same policy perspectives as Mr. Trudeau, but unfortunately is competent.
Hmm.
I would prefer an incompetent socialist. I would prefer a politician who wasn't able to affect the change they want. Mr. Carney has said very recently that although he scrapped the carbon tax because it was politically unpopular, if he didn't scrap the carbon tax, he couldn't become in power. He has said that he will make climate change the most important financial consideration in Canadian capital markets. Now, Canadians and investors who invest in Canada need to understand whether, from the point of view of their own investment portfolios and their own speculative portfolios, if Mr. Carney's preferences are the same as theirs. One of the cheapest asset classes in the natural resource world is Canadian oil and gas. Canada has wonderful energy infrastructure. They have a wonderful geological endowment. They have a truly spectacular human endowment. They have financial markets with a regulatory climate and a financial infrastructure to support the oil and gas business, which is to say everything is in place for a tripling of Canadian oil and gas stocks, except for the fact that the government of Canada doesn't see a business case for Canadian oil and gas, despite the fact that global markets are crying for it. This is why I have trouble with the Carney leadership. It's impossible now for me to reduce my holdings in Canadian financial services companies because I don't have any. If I did, if I owned the Canadian banks, which are great banks, or if I owned the Canadian insurance companies, the Manulifes, the Fairfaxes of the world, which are great insurance companies, I would sell them because they're bets on the Canadian economy. And I believe that the Canadian economy will continue on its current track, which is down.
What about Canadian resource stocks? Should resource investors, mining stock investors, energy investors, should they reconsider investing in Canada as of this moment, or is that not warranted?
I don't think that you can assign Canadian companies a political risk premium anymore. I don't think that you can say to yourself, Ontario, Quebec, Saskatchewan, British Columbia are premier resource areas. Canada has a spectacular resource endowment. They have the best financial infrastructure in the world in terms of resource capital markets, second to none. They have great human resources. But the truth is that the royalty take in Canada is going to go up. The tax take in Canada is going to go up. The permitting challenges in Canada are going to go up. What won't change for a year and a half or 2 years will be Canadian preferences for Canadian resource projects. So their cost of capital for a year and a half or so is going to continue to go down relative to other locations. But over time, math matters more than preference. So for me, a Canadian project needed to be equivalent to or superior to an Australian project or an American project, because I considered in particular Quebec and Saskatchewan to be premier political jurisdictions on a global basis. With a competent enemy of resources in charge of the country, Mr. Carney, I no longer consider that to be the case. I can't pay a political premium to own a resource project in Canada because I think it's a politically challenging place.
I see. Well, before we wrap up here, Rick, in addition to the Gold Boot Camp coming up here on May 10th, this Saturday, actually, we also have your Rick Rule Symposium coming up later this summer in beautiful Boca Raton. I want you to take some time to talk about that and tell the audience what they have to look forward to there if they choose to attend, either in person or virtually.
Let me tell you the selling point on both the boot camp and the conference. These are the only investor education products I know that come with a full money-back guarantee. If you come either to the boot camp or the symposium and you think for any reason that you haven't gotten your money's worth, email me. I'll give you your money back. Unconditional money-back guarantee. Nobody I know offers that guarantee. We've offered it for 30 years. So we start by saying your satisfaction guaranteed or your money back. Nobody else does that. How can we do it in the conference? Well, first of all, we've been doing it for 30 years. We're getting pretty good at it. We have great keynote speakers. This year in particular, we have the David Stockman, the former director of the Office of Management and Budget in the Reagan years, talking about the probability of success for the Department of Government Efficiency, which, by the way, is nil. But importantly, this guy's not a journalist. This guy's from the belly of the beast. He talks about management and budget because he was the director of the Office of Management and Budget, in addition to being a senator. We have Nomi Prinz talking about the structure of Wall Street, not as a journalist, but rather as a former partner at Goldman Sachs, again, from the belly of the beast. We have Daniela DiMartino Booth talking about the politics of the Fed, not as a journalist, but rather as an analyst at the Fed. Jim Rickards talking about the interplay between Wall Street and Washington, D.C. Who better than the general counsel at Long-Term Capital Management, whose failure almost brought down Wall Street? You follow what I'm saying? Your big picture commentary doesn't come from failed journalists. It comes from players from the belly of the beast. Then our portfolio managers, our asset managers, aren't people who came into resources because they failed at crypto or failed at marijuana stocks, but rather these are people who have made money on the front lines in natural resource investing for 20 or 30 years. We have the living legends, billionaires who on stage tell you how they built multi-billion-dollar mining or oil and gas companies from scratch, telling you how to identify the 5 or 10 or $25 million market cap companies of today that will be the $5 billion market cap companies of tomorrow. Finally, at our conference, unlike any other investment conference I know of on the planet, every single public company or exhibitor has been vetted. If those companies aren't owned in the accounts of the conference sponsors, they can't exhibit on the conference floor. That doesn't mean, sadly, Danny, that every stock that I own goes up, but it does guarantee that every single exhibitor on that floor has been vetted. We own those companies. At every other investment conference I know of, the qualification to be an exhibitor is a check that cashes. At our conference, we have to know the companies well enough that we own them in our own accounts. Once again, all this comes with a money-back guarantee. Whether you attend live or live stream, we are going to give you 50 hours of programming over 4 days, more than you can absorb. And so the entire proceedings are going to be recorded, and you will have access to those recordings for a full year, and you will need it. Danny, let's talk about who should not come. Somebody who buys the daily newspaper to read the funnies should not come. You have to be prepared to invest in yourself. You have to be prepared. We, before the conference, will have done 30 or 40 hours of interviews on YouTube. You can hear from the speakers, you can hear from the exhibitors before the conference. If you're the kind of person who actually wants to understand how to invest, who wants to understand why they invest and what they invest in, if you are prepared to spend 50 hours at the conference working and then spend another 50 hours after the conference working, this conference is for you. If you're somebody who buys the daily paper to do the crossword puzzles, do yourself a favor and do me a favor and don't come. This is this is designed for those people who want to be better natural resource investors and are prepared to take the time and put in the effort to do that.
Yeah, so you're going to be not only rubbing elbows with some of the greats out there. I mean, people would kill to learn soccer from Lionel Messi or to learn basketball from Michael Jordan, but I mean, you're getting the chance to learn resource investing from some of the best in the industry. I mean, this is a very great opportunity to look at, and you're also. It sounds like you're filtering out all of the all the Johnny come latelys and the unserious people from the conference. So the people that you will meet in the conference, like yourself, will be serious investors. So there's plenty of chances of not only just networking with these experts and getting to meet these experts, but networking with other people like yourself who are passionate about resource investing and things along that line.
What you say is true on both counts. The idea at a conference like this with, several hundred high net worth investors who are focused on resources means the idea that all the knowledge at the conference emanating from the dais out to the audience is silly. You can learn from each other, and you should. The second thing is the first point you made. I had an attendee email me 8 years ago saying, Rick, the ability to follow Robert Friedland and then Ross Beatty, self-made billionaires in resources around your exhibit floor, and watch what booths they stopped in front of, and eavesdrop on the questions they asked was worth the price of admission. The whole rest of the conference was free. And I think that's a really, really, really important note. I mean, you're going to have money managers there who manage billions of dollars. You're going to have family offices where the family fortunes came from mining and oil and gas. You are going to have a conference that's good enough that the speakers don't spend their time in their hotel rooms when they're not speaking. They're participating in the conference, and you'll have the ability to interact with them, which is invaluable from my viewpoint.
Very fascinating stuff. Looking forward to both of those, the symposium as well as the boot camp coming up later this weekend. Rick, thank you so much for coming on, my friend. It's always a pleasure having you and getting your insights. Anything else you want to talk about before you wrap up here?
One final thing. We've made this offer to your listeners before, and thousands have taken us up on it. Any of your listeners who care about making my comments on natural resource investing personal can do so for free. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks. I personally will rank them 1 to 10, 1 being best, 10 being worst, and respond via email. And I'll comment on individual companies where I think my comments might have value. Please no pot stocks. Please no crypto. Natural resource stocks only. List your natural resource stocks at ruleinvestmentmedia.com.
Excellent. Well, hey, Rick, always a pleasure. Looking forward to our next chat down the line here. Guys, if you enjoyed this podcast, drop us a like and comment, go, Rick, go in the comment section. If you agreed with Rick's analysis, if you disagreed with anything, that's fine too. Let me know what you disagreed on. I do indeed read the comments. Also, subscribe to the channel so you don't miss an episode. Every little bit helps in getting these videos out to more people and getting us up and boosted in the YouTube algorithm. So massive thanks to you guys out there. Also check us out on Substack. It's capitalcosm.substack.com. Get early access, ad-free versions, and uncensored versions of all my videos for the videos that warrant it. And of course, check out the links down below for the Gold Boot Camp as well as the Rick Rule Symposium. We've got special links just for you guys. Click the links down below in the description or pin comment to get started. All right, guys, thanks for watching. I'll catch you later. Bye.